Hello, I'm Clara Hermit and welcome to Mould on the Markets with our Investment Research Director, Russ Mould. Russ, how are you?
Very well, Clara. How are you?
I'm not too bad
Good,
at all.
I'm delighted to hear it.
Russ, it's August.
It is.
What is going to get advisors and their clients all hot and bothered this month?
And I think the big issue that people will be looking at right now is the fixed income arena, particularly because the Financial Conduct Authority has actually just put out a notice paper on the corporate bond fund space.
So what did regulators have to say?
Yeah, it's interesting that the FCA basically suggested that corporate bond funds are not risk-free, which, let's face it, is perfect common sense, but that it is concerned that particularly retail investors, but also possibly some clients, have started to get used to the fact that, or think about the fact that bonds are safe havens. Now, the FCA points out quite rightly that if central banks start to increase interest rates, then on face of it, bond yields will go up, bond prices will go down, just the same relationship as it is for shares. Now, again, a lot of retail customers definitely, some clients possibly, may have just therefore neglected the fact that it is possible you can suffer capital value hits that more than offset the value of the coupons to the bondholders. And I'm sure many advisors have got their clients thoroughly on top of this situation, but nevertheless it's something that's well worth bearing in mind.
Bonds are still doing well though, aren't they?
Yeah, this is the interesting thing. If you look at the chart behind us, you've actually got the performance of some of the major asset classes from fixed income and from equities. And as you can see, the equity ones are in red and the bond ones are in blue. Now, shrewd advisors will notice, one, the FTSE All Share is actually the worst performer of the lot. Two, that all of them have actually generated a positive return in the first 7 months of the year, quite unusual. And three, emerging market bonds, corporate and sovereign, have been the best performers of the lot. Now, that might get some advisors and clients thinking, actually, yeah, there might be a bit of a bond bubble here because you've got very, very substantial yield compression. And certainly there is an argument that when central banks taper off QE, begin to neutralise that, bond yields will rise and bond prices will fall, because if central banks have been the biggest buyers, when they disappear, you'd expect there to be a problem.
So that all seems pretty logical.
All seems perfectly logical, except there is a counter-argument which is presented by our good friends, the Japanese. And the second chart behind us shows the Japanese market, or Japanese government bond market, since 1989, when the equity market peaked. And as you can see, it's dead easy. Bond yields down, bond prices through the roof. And that's basically because you've had a country saddled with debt, suffering low growth, even deflation, sounds relatively familiar possibly, and therefore equities haven't had a look in and people have hunkered down in JGBs because the yields have actually more or less compensated you for some of the risks on offer. So that is certainly a counter-argument to any of the bearish arguments that you might see out there.
So if we get a repeat in the West, then bonds might not be the accident waiting to happen after all.
That's the theory, and Bill Gross of the fund management giant PIMCO has actually sort of articulated a few similar thoughts along those lines. I mean, if you look at this final chart behind us, this shows a federal funds rate, Bank of England base rate back for about 30 odd years. Now, looking at it on face value, they're only going to go one way, right? But I guess Gross's argument is to what degree and how quickly. He's suggesting it may only, the new normal may only be 2% on the Fed funds rate, not 4%, on the grounds that growth is going to be quite sluggish, the sovereign debts are still quite high, the Fed can't fund really high interest rates. Under those circumstances, then actually 10-year treasuries at 2 3/4, 30-year treasuries at 3 1/4 don't look too bad, if you believe that scenario. And also emerging markets, there could be further yield compression as this scramble for yield continues. So it's definitely an area that everybody's got to keep very, very close eye on. But at the moment, the arguments seem pretty finely balanced either way.
Okay, thank you, Russ.
Pleasure.
Thank you as well for joining us. We'll see you next time.